Hello and welcome. It is March 7th, 2024. We're live on LinkedIn and YouTube. And welcome if you're joining us live or you're watching later. We are recapping everything that happened that matters in February 2024 for the commercial real estate capital markets. I'm Tim Milazzo, CEO of StackSource. I'm joined by my colleague, Director of Capital Markets, Huber Bongelin. Huber, how are you doing today?
Doing well. It was raining. I'm here in Orange County. It was raining yesterday, so it's nice and sunny better weather today. So how are you doing, Tim?
We're doing great here in Florida, and but I want to hear how the market's doing. So I want to know what happened in February that you think is the most noteworthy, and why don't we start there?
I love it. Let's get into it. So first, two main bullet points for today. The first one here is that commercial lending is slowly accelerating to start off the year. So total commercial mortgage lending is expected to rise 576 billion this year, which is a 29% increase year over year. So that is a great sign. As we all remember, 2023 was a pretty tough year for transaction volume, largely due to rate volatility as other market dynamics. But now expectations are better for this year. So we're excited to see continued acceleration in the lending market, more activity. The second big bullet point that happened last month and for the month of February was MBA CREF down in San Diego. It was great seeing, especially if you're on this call, a lot of our fellow colleagues. We had about 4 StackSource team members attend the MBA, and it was great seeing our capital relationships there, both debt and equity providers. Since the beginning of the year, we've had the privilege of speaking to hundreds of different capital providers, both debt and equity, like we said. And some of the key themes that we saw and continue to hear and also see published, which is nice, is that there's a lot of dry powder on the sidelines, especially after 2023, that are looking and ready to be put to work. And we're starting to see that, continuing to see that actually in the bridge transitional lending space. At that conference also, one of the great signs was the tone of the conference changed from last year. So this is an annual conference, but the tone is cautiously optimistic this year for 2024 versus last year where interest rates were rising. It was a little bit more negative sentiment last year on where things were headed. When would rates stop their upward trajectory? So it's nice to see that there is that renewed confidence, that tone, that sentiment in that conference, that better sentiment going into 2024, and that's always a great sign. Then lastly, the last theme that we saw is the expectation for transaction volumes. The market is expecting that transaction volumes, more activity will pick up this year, especially in the second half of 2024. So those are some of the key themes that we saw for the month of February.
Excellent. And as we transition to looking at some data and the Treasury and inflation rates, I'm just going to mention right up front, if you're watching live and you have a question about anything that Huber and I cover here, go ahead and drop it in the comments. We'll be doing question and answer at the end, in addition to some pre-submitted questions. But Huber, with inflation looking like it's flattening out and the Treasuries, kind of dipping down and back up, what are we seeing as far as these market indices?
Right. So that is a key theme that we're seeing and a welcome trend line. I mean, a lot of eyes are going to be on Jerome Powell from yesterday's testimony as well as today's. A lot of literature publishments coming out, analyzing what he said. But it's great to see that inflation continues its downward trend, but starting to flatten around that 3%. It's an encouraging sign to see that trend line downward. But as the Fed continues to state, their commitment is getting inflation down to 2% while maximizing employment. On the other end, so that's the green line there, that inflation line. Then we see some indices that we're tracking, some benchmarked treasuries, as well as term SOFR, the blue lines, and kind of that golden line here. And you're starting to see that strong trend of rates stabilizing, right? Versus last year, that upward march in rates. This year, we're starting to see that either flatten / some months lower, some weeks lower. So kind of taking it week by week, depending on what data comes out and where the market thinks the Fed will move rates moving forward. But again, it's a welcome sign seeing that start to flatten out with the market expectation that sometime this year, probably towards the middle part of this year, towards the end, rates will start lowering from Fed action. So those are all welcome signs of things to come this year.
On the heels of this, commercial property price index, which is heavily affected by interest rates and having higher interest rates for longer. We're seeing it continue to fall. So we have a much longer view. As according to Green Street's commercial property price index, which they index to 100 as of 2007. So that's pre the last cycle and the last commercial real estate and really real estate overall and economic crash. They set if the average commercial property price per square foot was $1 then, it fell all the way to 63 cents on the dollar in the last cycle. Through this cycle, a long cycle up through 2023 or late 2022, it got up to $1.55 compared to 2007's dollar for a value of an average commercial property. We're now down to 121 or so. So we've lost 30 cents on the dollar for the average commercial property value compared to 2007's value. So that's pretty significant. It is not as far yet at this point, unless we see continued dropping in CPPI. It's not as far as the great financial crisis of 2008, but it's pretty steep. And with interest rates and with Fed actions and the availability of lending, we are going to talk a little bit about in the months ahead, but where is this going to go? Is it bottoming out? Has become a key question for real estate investors and lenders, so that they can understand, is this a buying opportunity? Is this a refinancing opportunity with cash in and cash out? And all these real estate decisions are really being largely impacted by the average commercial property values and comps. And so that's an important point, is that we're down about 34 cents on the dollar compared to 2007 values. And we're getting back towards like, hey, it's 20% more valuable than 2007, but not 50% more valuable than 2007. So huge change here in the last year or so. So Huber, where are commercial mortgage rates now for some of the major types of capital providers?
Absolutely. So if you're joining us for the first time, here are the different types of capital providers that we're actively tracking to the day as we get market intelligence coming in. We just showed you on the last couple of slides, kind of historical trends, future, what we're kind of seeing more in a graphical format. But this is today. What are we seeing today in terms of different types of providers, from agency type lenders you see at the top, CMBS, regional banks? You can go to our website, stacksource.com, and under the rates tab, you'll be able to see where are these rates trending here. And of course, if you have a specific deal, you can always reach out to us and talk to one of our capital advisors. These rates here kind of represent a lower and upper bound, because every deal, as we know, is very different. The risk inherent to the deal, who is it appropriate to actually go through? That's where one of our expert team of capital advisors can help you out. Of course, there's going to be outliers where maybe you're actively in the market and your rates are higher than this or lower than this, but this is the typical range bound that we're seeing for lenders today. So again, if you have questions specific to your deal, you want to explore different financing scenarios for maybe one of these types of lenders that might be appropriate to your deal, please always do reach out to us directly. So those are some of the rates. These are the rates that we're seeing today. Again, they're updated daily and on our website. But moving to the next slide, we'll go into specifically on some of these providers, key themes that we're seeing when it comes to underwriting and deal structure. So we'll start with the first bullet point there, CMBS and CLO market spreads tightening. That is a key theme that we're seeing, is that they're coming back. Well, maybe in 2023, they were largely silent because of the rate volatility. One of the themes that we talked about earlier, the renewed confidence, where are rates trending this year? We're seeing deals, especially in the CMBS market, these credit markets, being priced with full-term interest only, which is great from a cash flow perspective, as well as the DCR coverage requirement, that stipulation, coming back down to what we're kind of been used to in this market over the past decade at a 1.2x, 1.20 DSCR coverage ratio. So that's what we're seeing in the credit markets there. Second bullet point that you see is that bridge and transitional deals are searching for yield. So what does that mean, right? Being able to provide debt-like structures and get these maybe high single to low double-digit returns, that yield, that interest rate that they're seeking. They're really hot on story deals, distressed deals, where there's a great sponsorship in place, there's a great business plan that makes sense. it may not be appropriate yet for a perm type lender such as CMBS that we talked about in the first bullet point, or maybe some type of bank or credit union execution, but more appropriate for a debt fund or private capital type play where there's a story behind the deal, there's risk inherent to it. They'll price in that risk, that yield into the deal. That money is pretty hot right now. There were a lot of those that we saw at the NBA conference that were searching for good deals. So that money's absolutely out there if you have a transitional type play. And the last item there, the third bullet point that you see, is the trend towards short-term life company deals. So life companies have usually been, unless you're working in the more institutional space, 30 million and 50 million above type deals, there's smaller life companies as well. And they're usually looking for very safe type deals, low leverage type deals, but they're willing to give great interest rates for those deals. Typically, those terms were around 5, 10, 15-year fixed terms, maybe amortized over 20 to a 30-year basis. But a trend that we're seeing in the life company space is that because borrowers are expecting rates to lower in the future, they don't want to be locked in for 5, 10 years at today's interest rates because they think it's going lower. So because of that expectation of future lower rates, life companies have adapted, and now they're offering what we're seeing a lot, these 2-year, 3-year type perm deals where the borrower can lock it in, get their great interest rate today for today's standards, but in 2-3 years be able to refinance if the expectation comes to light that rates lower. So those are some of the 3 key themes that we saw in the month of February for underwriting and deal structure. And for months ahead, I'll pass back over to you, Tim, to see what are we expecting for the months upcoming this year.
Excellent. Thanks so much, Huber, for summarizing hundreds of conversations with lenders that you're having, and we'll continue to talk about it with some questions coming in from the live feed. But in the months ahead, so as I talked about CPPI, and we're down at 121. Where does this go? Is it going to 120? Is it going to 105? That has huge implications for all of these capital markets players, whether you're providing debt, whether you're providing equity to somebody else as a lead sponsor, if you're taking on a deal, or if you're a buyer. And so the question is, have we bottomed out? Are we near bottoming out? And one of the key events over the last month or so is that a couple of big private equity real estate entities, including Blackstone, have said we're at the bottom of the market. So they are looking at economics. They're looking at commercial property deals. They have suffered some of their own defaults on deals from years past, and they've raised new funds for new strategies. And they're at least pitching. And take this with whatever angle you want, knowing that general partners are pitching for LP capital, but they're calling a bottom, and they're putting, when a large firm calls a bottom of a market, they're putting their reputation on the line for years to come. And so that's an interesting data point, and it's going to be interesting where property values settle. Some of the asset classes potentially hopping back up in commercial property value, which ones will continue to fall. There's a negative sentiment for office and still for multifamily right now as far as values overall. And there's positive sentiment in some other asset classes out there, including retail. So that's something to watch in the months ahead. In the next 2-3 months, commercial property values starting to recover would really be a boon for the market and for transaction activity. Federal Open Market Committee, will we see short-term rate decreases? That is the Fed funds rate, which is directly impacting the prime rate for lenders that are residential and for based on credit scores. But it's also just a big market sentiment signal to hear what the Federal Reserve has to say about the state of the economy and what they're going to do about it, and how much economic firepower is going to come from the federal bank. And finally, where will dry powder go? So on the bank side, there's not as much dry powder as you'd imagine, but on the private equity and debt fund side, there are record-breaking levels. Where will that go? What types of properties, where in the country, is also going to be an interesting trend for the months ahead. I mentioned that office, still seen as a very risky asset class. Multifamily has more disagreements between real estate investors than we've seen in a long time. And multifamily has been such an amazing run over the last 10 years and now such an amazing fall over the last 18 months, that it's still hotly debated what the value of a multifamily property should be. And so that's going to be an interesting trend to watch in the months ahead as well. All right. Before we transition to that question and answer, and thank you for submitting questions, and please keep it going in the comments if you are watching live. We're StackSource, so Huber and I are colleagues, and have a bunch of other capital advisor colleagues across the country that advise on the best debt and equity options for construction deals, acquisitions, refinances. We have nationwide reach, and we provide competitive terms from all our capital providers with transparency. No under the table fees on the lender side that you don't know about, and you get to see all of your matched capital providers in a portal. And that's StackSource. And reach out if you'd like to talk about a deal. Let's keep talking about the market. So we have a couple of questions coming in addition to some pre-submitted questions. One of those is, what asset classes are being underwritten and which are more challenging to get approved? I mentioned office and multifamily. Huber, what is your opinion on this? What other asset classes come to mind?
Yeah, I would say let's start with the challenging one. It's office, no doubt. That's one that's some opportunities there. Is maybe an acquisition deal with a strong turnaround play with in great environment, and they're able to buy it or come to an agreement with at a very reduced purchase price, very reduced basis. That's some opportunities in office, but that's still probably the most challenging one to get underwritten. Some of the favored ones you had mentioned, industrial continues to be a darling. Multifamily, yes, still very much up there, but yeah, there is still some discussion there around multifamily. And also what we're seeing, triple net deals with strong credit tenants. Those ones are always absolutely a favorite with lenders, just because they're very easy to underwrite depending on the strength of the tenant that's actually in there. So those are some of the asset classes that we're seeing that are favored versus ones that are a little bit more challenging.
I agree. And industrial has been the most resilient through this cycle. And something that kind of gets lumped into industrial, but is now becoming an asset class in its own right, data centers, with not only the continued growth of, and industrial and e-commerce go well together, and that's the contra retail play. But now with the growth of AI and, how much computing power and storage power the world is projected to use leading up to 2050, data centers is another in-demand asset. And so that's another one that we'll expect to see a lot of money pumped into.
Absolutely. Yeah, look, another question that came in on what we had talked about previously, but could you explain a little bit more how tightening spreads in the CMBS and CLO markets are impacting underwriting and deal structures?
Yes. So spreads are based on treasuries. So like you look at the 10-year treasury rate or the 5-year treasury rate, those are going to be the underlying indices for the pricing of CMBS loans. But when we said the spreads are tightening, we're saying the premium over the treasury rate is shrinking. So all else equal, especially for lower leverage loans, we're seeing lower rates for CMBS as long as treasuries don't continue to spike up, and it's been up and down and volatile over the last few months. But this is a welcome sign, particularly because, and I see another question in here is about how active are different types of lenders. Banks and credit unions have suppressed their lending levels, and they're not coming back in force right now. So as you talked about earlier, Huber, we're expecting a 29%, 30% bump in commercial mortgage volume this year. We're not expecting a huge uptick from banks and credit unions. There are a lot of banks and credit unions that aren't technically distressed, but they're not very confident in their balance sheets either. So as we see spreads tightening for CMBS, that's going to take a lot of the perm lending volume that would have otherwise been a bank or a credit union loan, especially for deals that are stabilized. CMBS doesn't want to hear about a value add play. So those are typically going to go to debt funds. Debt funds are going to be very active this year. CMBS is going to be much more active this year than they were last year, both of them taking deals that might have gone bank in the past. And that's my take. And I'd love to hear if you have additional thoughts on, types of lenders that you're seeing, kind of bullish or more active today.
Now you hit the nail on that. Like I said, we saw that at the conference as well. Debt funds, transitional, bridge type deals, those are the ones that are very, very active now. I think maybe in a couple more months, latter half of the year, as that confidence continues, as interest rates, that reality of rates are starting to close, when that comes to fruition, we might see a lot more capital coming off the sidelines as well.
Yeah, we should probably throw one more in there, which is government agencies. So Fannie Mae, Freddie Mac, they have what they want to advertise as, but it's sort of free money from the government. They're allowed to take a loss. They're allowed to securitize with kind of unfair rules versus other banks and creditors. And so they provide non-recourse debt on multifamily properties specifically. The more affordable it is, the better. The more green it is, the better. But they're getting into very light transitional lending that would have otherwise been like bank and credit union loans as well. And so that's a third capital provider that's like edging into what used to be regional bank type lending. They've always been a dominant player for stabilized multifamily, but now they're becoming a player for near stabilized multifamily properties as well. And so I think that's another capital provider that is increasingly important if you're a multifamily investor, to understand what those loan programs are. And we talk through this with borrowers to understand, hey, when can I get a Fannie Mae and Freddie Mac? And why do I want that versus talking to my relationship bank? And that's a conversation we have quite frequently. Hubert, another pre-submitted question for you. What risks should investors be mindful of with the short-term life company deals that you were talking about?
Sorry about that. I think I was muted there. So we had talked. Sorry about that. I was talking and then it wasn't
welcome back.
Here. Yeah, sorry about that, everyone. So we had talked about how borrowers' expectations are that rates will be lower in the future, and that's why life insurance companies are adjusting their terms from maybe typically 10-year term down to even a 3-year term to meet those interests, those demands from borrowers wanting a shorter term duration. However, some of the things that you need to be mindful of course, as we know, the future is never certain. So everyone's kind of thinking that and hoping for that, but you never know what the future may hold. So there's always at least a small chance. Depends on how you think the market will shake out. It could be small, could be medium, could be large, but there is refinance risk inherent with that strategy of accepting or wanting a lower term duration for your loan, right? It's a bet. It's a bet that in 3 years from now, when that maturity comes due, the market's either going to be flat or lower. You're hoping that it is lower, and then your strategy works out. Great, you got a shorter term duration. However, what if that's not the case? What if it's higher? What if the markets freeze up? That's always a possibility. There might be some type of black swan event that occurs, and it makes it harder, a more difficult refinance environment. Well, now you're faced with a decision. You have to do something by year 3 versus traditionally, right? We talked about you had a longer term, you had maybe 5-10 years. So you had more time at a fixed interest rate. So if the market stays flat, if the refinance environment is still strong and healthy, or if the market lowers, then you're perfectly fine with this strategy of wanting a lower term. It's more beneficial to you. But you take on that risk that the market may be different from what you expect 4 years, 3 years from now, 4 years from now, when your loan comes due.
Absolutely. There's no avoiding a refinancing risk. There's only pushing it down the road and handling appropriate leverage, right? And then executing your business plan.
That's right.
I've got another question coming in from the live stream on LinkedIn about construction loan volume. Are we seeing it tick up in a meaningful way? What's your thought on that, Huber? And I can pepper in some thoughts as well.
That's great. No, I think that I personally haven't. Tim, you might have some data from the company angle, but I personally haven't seen many construction deals in the past year tick up in a meaningful way. And again, construction deals are a riskier type of play. And typically you want to take on risk for most individuals, maybe psychologically speaking, when you have a clear view of what that future holds. Because when you have a construction deal, you might, depending on the level of construction that you have, might be a 2-year deal, 3-year deal. There might be 6-12 months of stabilization. So if the future is murky, which it had been previously, that is an obvious sign why a lot of people may not be going head over heels and pushing into construction deals. And especially when, and Tim, maybe you can speak more eloquently to this, cap rates are still in more of an exploratory mode. While maybe 2 years ago, 3 years ago, you kind of saw multifamily deals trading at a 3.25, 3.5% cap rate, right? What is that new cap rate? The market is still figuring that out. We had talked in previous sessions about bid, ask, spread, but until you see meaningful trades, right, that will set the new standard for where cap rates need to be underwritten to. So I haven't seen construction volume pick up in a meaningful way, but Tim, you might have a similar or a different viewpoint on that.
I agree. And beyond the cap rate point, which is correct, I think even rent comps have been debatable for construction deals. Construction, it's getting pinched by multiple factors. The value of the property that you finish is one of them, as you pointed out. How about the income of the property that you finish, which further impacts the value because rents aren't just rising everywhere. So if you're in a strong market where rents are still rising, where you're seeing population growth coming from other areas, you can start a conversation then. Like I think there are areas, there are a few non-starters. One, if you don't have experience as a developer right now and you're looking for construction, you're not going to get it. If you don't have an area with a rising population or a strengthening economy, like the actual region and city and even the neighborhood, you're not going to get it. And then finally, unless you're an A-tier sponsor, so somebody that you walk in and you're royalty and you're famous for developing real estate, you're probably talking to debt funds at that point, right? Because banks and credit unions are passing on most construction deals. And so now you're talking debt funds and it's a higher cost of capital. It may be high single digits starting at around 9% down to like the low teens, like 9 to 13% for the senior. And then you may be constricted on the leverage and having to bring in a preferred equity or equity partner. It's expensive money. And not every deal pencils while your construction costs are going up, your promise of income is going down, and like you're not getting full leverage. There's just a lot of deals that get shelved. And so that's been happening for the last few quarters. I haven't seen it pick up early this year yet. It's coming. I don't think it's there yet. So, all right. I think we've answered our questions. If you have questions and you're watching this later and you're not a time traveler, hello@stacksource.com is a great way to get in touch with us. We can answer questions. We can get on a call, and we'd love to help you get the right capital together to get your deal done. If it's easy, we can get you a lower rate. If it's hard, we can put it together and find capital sources that you can't find without us. That's our value. Huber, really good to talk with you today.
Likewise. Thank you, everyone, for joining us. Thank you for the time. Hope everyone has a great rest of the week here. And absolutely, please do reach out to us if you have questions at all. We're always here to help.
Excellent.